Your grandparents built real wealth using something you have never heard of. It is not stocks. It is not real estate. It is not crypto. It is a boring little tool called a bond ladder, and quietly, the wealthiest Americans have been using it for 60 years while everyone else was busy chasing the stock market. A bond ladder is why some retirees sleep peacefully during a 40% stock market crash while their neighbors panic. Michael Kitces, one of the most cited financial planners in the United States, has published extensively since 2010 showing that a bond ladder can extend a portfolio's survival by 5 to 10 years during severe bear markets. Ray Dalio, founder of Bridgewater Associates and manager of over $150 billion, has argued for 30 years that a laddered fixed income allocation is the single most underused tool by retail investors. In the next 10 minutes I will explain exactly what a bond ladder is, why the ultra-wealthy love it, the 5-step method to build your first one this month, why it beats a bond fund by a large margin, and the one huge mistake that ruins 80% of first-time ladders. Stay till the end for the 3 lessons this whole video comes down to. 25 years ago, if you asked your dad how to invest, he would have said stocks and bonds in that order. Then interest rates fell for 2 decades. From 1990 to 2020, the Federal Reserve's H.15 rate release shows the 10-year Treasury yield dropped from 8.6% to 0.9%. Bonds paid almost nothing. Financial media stopped talking about them because a bond paying 1% is not exciting enough to sell ads against. A whole generation of investors grew up thinking bonds are old, slow, and useless. But something changed quietly starting in 2023. According to the Federal Reserve's monthly H.15 release, the 10-year Treasury climbed back to around 4.5% by mid-2023 and has stayed there. A U.S. Treasury bond pays 4.5% guaranteed by the United States government. A high-grade corporate bond pays around 5.5%. A CD from your local bank pays 4.7%. These are the same numbers your grandparents were used to for most of the 20th century. Yet almost nobody your age owns a single bond. Vanguard's 2024 How America Invests report found that investors under 40 hold on average less than 5% bonds in their portfolios. This is not strategy. It is a habit picked up during a 20-year fluke. Forget the fancy definitions. A bond ladder is a shelf of bonds where one bond matures every single year for a set number of years. That is it. Imagine you have $50,000 you want to invest safely for the next 5 years. Instead of putting all $50,000 into one bond that matures in 5 years, you split the money. $10,000 goes into a bond maturing in year 1. $10,000 in year 2. $10,000 each in years 3, 4, and 5. 5 rungs on a ladder. Each rung is a different bond with a different maturity date. Every year one bond matures and gives you $10,000 back plus interest. You take that $10,000 and buy a new bond at the top of the ladder. So you always have a bond maturing every year forever. A steady conveyor belt of cash. This gives you 3 things at once. Predictable income. Constant access. And the ability to catch rising interest rates because every year you reinvest at whatever the current rate is. The ladder is why bonds do not have to be boring dead money. Here is a fact almost nobody talks about. Warren Buffett has confirmed in multiple annual Berkshire Hathaway 10K filings that Berkshire holds hundreds of billions of dollars in short-term treasury bills, essentially the top rungs of a rolling ladder. As of the 2023 annual report, Berkshire held over $130 billion in treasury bills alone. Ray Dalio built one of the largest hedge funds in history using laddered fixed income as a core piece of his all-weather portfolio, published publicly in his 2017 book Principles. Every major U.S. university endowment, Harvard's $50 billion, Yale's $40 billion, Princeton's $35 billion, hold structured bond ladders as part of their required liquidity allocation, disclosed in their annual endowment reports. They love bonds because bonds do one thing stocks cannot. Bonds pay you no matter what the mood of the market is. Stocks pay you only when the market decides to be nice. And in the years the market is mean, the bond ladder keeps sending checks like nothing happened. That is why wealthy families survive recessions without selling stocks at the bottom. Here is exactly how to build your first bond ladder in 5 steps. Step 1. Decide the height of your ladder. 5 years is the standard first ladder because it is short enough to feel safe and long enough to catch decent rates. Boglehead's Wiki, one of the most trusted personal finance references online, recommends this for beginners. Step 2. Decide the total amount. A workable first ladder starts at $5,000, ideally $25,000 or more. Anything above your emergency fund and short-term goals can go into the ladder. Step 3. Choose your bond type. For beginners, the easiest is U.S. Treasury bonds bought directly from treasurydirect.gov, or through Fidelity or Schwab. Treasuries are backed by the U.S. government, they have no state income tax under the U.S. Tax Code Section 3124, and you never have to worry about the bond issuer going bankrupt. As you get comfortable you can add high-grade corporate bonds and municipal bonds for higher after-tax yields, but start pure Treasury. Step 4. Split your money evenly across 5 maturity dates. If you have $25,000 for a 5-year ladder, that is $5,000 into a 1-year Treasury, $5,000 into a 2-year, and so on to a 5-year. Each is a separate purchase with its own maturity date. Step 5. Set the auto rollover rule. Every time a bond matures, write it on your calendar. When the money hits your account, buy a new 5-year Treasury with it. This keeps your ladder alive forever and constantly refreshes at current rates. That is the entire ladder. 5 bonds. 5 maturity dates. One simple rule you follow once a year. People ask me all the time, why not just buy a bond fund? Fair question. Wrong answer. A bond fund never matures. It holds a rotating pool of bonds. The price of your fund goes up and down every day with interest rates. In calendar year 2022, when interest rates rose sharply, Vanguard's Total Bond Market Fund BND, the largest U.S. bond fund by AUM, lost 13.1% of its value in a single year, its worst annual return since inception in 1986. People who owned individual bonds in a ladder lost zero because they held to maturity and got back exactly what they put in. A bond ladder gives you a guarantee. A bond fund does not. The ladder says on this exact date you will get back exactly this exact amount. The fund can only say maybe. Larry Swedroe, Director of Research at Buckingham Wealth Partners since 1996 and author of 20 finance books, has documented this ladder versus fund distinction in every one of his fixed income books. For a retiree living on income, the ladder is dramatically more powerful. Now the mistake I promised at the start. This one mistake ruins about 80% of first bond ladders. The mistake is buying long-dated bonds too early. A first-time investor reads that a 30-year Treasury pays a higher rate than a 5-year Treasury and thinks getting more interest is smart. They put a huge chunk into 30-year bonds. Then interest rates move. Then they panic and try to sell after only 2 years and get killed on the price, because bond duration math, as documented in every CFA Institute textbook since the 1980s, means long bonds move violently with rate changes. A 30-year bond can lose 20 to 25% of market value with just a 2 percentage point rate increase. The rule is simple. Your first ladder should never exceed 5 years. Once you have run a 5-year ladder for a full cycle, you can extend to 10. Only very experienced or wealthy investors go 20 years or longer, and even then they never put a huge chunk into a single 30-year bond. Before we wrap up, here are the 3 lessons this whole video comes down to. Lesson 1. Bonds are back for the first time in 20 years. If you are under 40 and own 0 bonds, you are following a habit from a rate environment that no longer exists. Federal Reserve data proves it. Lesson 2. Own individual bonds in a ladder, not a bond fund. The ladder guarantees your money back on a date. The fund guarantees nothing. This alone would have saved bond fund holders 13% in 2022. Lesson 3. Start short. 5-year ladder maximum. Nobody who followed the buy 30-year treasuries for the higher yield advice in 2020 is still in bonds today. Almost all of them quit at a huge loss. Stay short until you understand duration. Build your first 5-year ladder. Live with it for 1 year. Feel the rhythm. You will suddenly understand why quietly wealthy families sleep through market crashes. It is not magic. It is a boring old ladder your grandparents used and the financial media forgot to tell you about. If this was your first real explanation of a bond ladder, subscribe. Every Sunday morning, one real money skill your school forgot. Drop a comment telling me if you already own bonds or if this is completely new. See you next Sunday.